Well, hello, Daniel Schreiber. Welcome to an interview here with or discussion with Matt and I from Good Soil Investment. We've been looking forward to you as a very special guest for a while. I know we've been talking about it, and it's great to finally get you on and discuss some stuff about your baby Lemonade. I'm wearing yellow and in your team colors. I decided to put on a shirt this morning. I was so excited.
I'm deeply moved by that. Thank you so much, Emmet.
Sure. So, Matt, you became a customer of Lemonade recently in the last few weeks or months, actually now. And what's your experience been like? And maybe you want to walk Daniel through a little bit about your experience, and then we can kind of go into some questions, I guess, and see how things go.
Yeah, sure. Maybe it's good to kind of start this conversation off with just an anecdote and maybe why it's one of the reasons that we're kind of bullish. So we've been investors in Lemonade through our fund for I think over a year now, and really like kind of the business case of it, but have been kind of meaning to become a customer for a very long time. And I realized after I had actually pulled the trigger and become a customer, I was really putting it off primarily because I didn't want to go through the pain point of like calling my insurance agent and like dealing with all the paperwork and everything. Finally, I was just like, you know what, enough's enough. I need to, do this bit of research. So signed up for Lemonade Home. It was like a minute, maybe 2 minutes, something like that, just kind of remarkably fast for such a kind of complicated product. And then I was kind of surprised and delighted at the end of the experience that the virtual agent essentially said, would you like me to go ahead and cancel your old insurance policy? And I was like, you're going to remove this like huge headache from my life, this to-do of dealing with that. So that was just one kind of surprise that I had as a customer, that you would kind of go ahead and handle that part of my old customer relationship. So it was just a very kind of telling experience of why your customers like you guys so much. And so yeah, it was a very, very good experience, and I'm glad to be an official Lemonade customer now.
It's just wonderful. And much as we love bullish investors, our business is built on bullish customers. So Matt, wonderful to have you on board. Really appreciate your business. Thank you. And I'm glad your experience was as delightful as it was. As you can imagine, these kind of simple experiences, it took you a minute or two and was kind of breezy and chatty. That kind of easy, delightful experience really belies a lot of complexity. So in order to create such a simple and straightforward experience, you've got to really put a lot of hours, a lot of thought, a lot of expertise, a lot of technology in order to take away all those headaches. I'm so glad that, at least for you, the experience delivered on what it was designed to do. That's great.
Yeah, it absolutely did. And I think one of the things that's kind of so surprising about it is you would think with like a 1 or 2 minute process that you'd lose something of the nuance of a complicated insurance product between the deductibles and what you need to cover and all that sort of thing. But I actually found it was the opposite. Like when I'm talking to my agent and it's like on a phone and you've got all these deductibles and they're throwing around numbers, and you don't really understand what the impact of these choices that you're saying, like, oh yeah, I want $1,000 deductible or I want 500. But when you're doing it on Lemonade, you can actually see the quote changing in real time, and so you can have a better idea of what the trade-offs between the product are. So not only was it a better user experience in terms of my time, but I also felt like I was making a more informed decision in a much shorter amount of time, which I think is kind of miraculous to get that sort of result.
That's so great to hear. And it's one of the interesting things that we've found in dealing with the insurance space is there is a very legalistic approach to what transparency means. It's a heavily regulated industry, and the industry tends to like to put a lot of legalese at its customers, thinking that in so doing it's being transparent, but it really makes it as opaque as could possibly be. These long legalistic disclosures really don't help, whereas a little bit of iconography can go a long way. And you lose some precision when you reduce things to icons, but I think you more than make up for it in terms of explainability and people just understanding what they're engaging. And that's a trade-off that we've tried to get right really since the get-go. By the way, if you have to adjust your policy later, you'll find that the policy is a live policy. You can go in and make any changes in real time and it will take effect instantly. And if you ever have to cancel Lemonade, you won't have all of those concerns that you had about your agent, because it's an instant cancellation. You press one button and you're done. And hopefully if that ever happens, you'll come back when you're ready as well. So we do try to make sure that customers stay because they want to and not because they're locked in through some kind of guilt mechanism or other kind of ways in which you can pin down customers, as it sounds like you were experiencing for a while.
Yeah, absolutely.
And what Matt's kind of describing as, I think, a clear success for Lemonade is the front end. And that's exciting. But I think there's a lot of insurtech companies out there focusing on the front end experience as well. Maybe they don't do it quite as good, but comparably. But what gets me most excited, or what's always gotten me most excited about the long-term potential of Lemonade, is that you guys control the back end, right? I mean, you guys are much more vertically integrated than the other insurtechs, which are really just white labeling on top of the backbone of legacy insurance providers. And I'm kind of familiar, and the analogy I think of, because I'm from the fintech world myself, I used to work at Interactive Brokers, a financial firm, you know, an original fintech firm that built its own backbone, but didn't have a very good front end experience. But because it built its own backbone, it still succeeded despite a terrible front end experience. And then Robinhood comes along, has this incredible front end experience, but a terrible backbone. It doesn't control its backbone. It like piggybacked off of Pershing or some other legacy broker. And so it couldn't really manipulate its costs and the direction of its company very as well as. So I feel like you guys, the way I think of it is it's in the fintech world, if you combine the backbone of Interactive Brokers with the front end of Robinhood, you'd have like the best in class electronic, you know, futuristic electronic brokerage firm for everyone. And in the insurtech space, I think I see you guys as potentially the both of those combined in the insurtech space. That's why I'm personally excited for the long-term future. I mean, what do you see in terms of competitors in insurtech? Do you see any other insurance companies like making success in, you know, new startups trying to build their own backbone infrastructure like you guys have? What's your thoughts on the competition?
Yeah, I'll come to the competition in a second, but let me just address some of the points that you made. I think you're absolutely right. We decided from the get-go to become vertically integrated with all of the challenges that entails. I'm reminded as I hear you kind of lay it out, Emmet, there was an old quip, I think, attributed to Steve Jobs, that he said that people who really love software have to build their own hardware. That if you want the thing to work seamlessly, you can't be reliant on somebody else to do the bits and bolts upon which you put your software. And I think the same thing is true in insurance. If you think you can transform an insurance experience by taking a 100-year-old facade, structure, and just sticking a new facade in front of it, you know, that's skin deep. It's nice. Yeah. If you have a 100-year-old edifice, stick a nice skin on it. Why not? But there's a real limit to how much impact that can have, how much change that can entail. And I think you're touching on something else, which I'd love to come back to in a second. I want to address your question directly, but 2-3 years ago, I think if you asked CEOs at incumbents, they'd all heard of Lemonade and they knew what was going on. And I think you asked, hey, what do you guys think about Lemonade? They would have paid us the backhanded compliment of saying, they've got a neat app and they're good at PR. And the implication of those backhanded compliments was they don't understand the plumbing of insurance. This is, you know, this is an industry with its own technology, its own approaches, blah, 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 blah. And what I was saying to my team 3 and 4 and 5 and 6 years ago is what people are seeing now, the 90 seconds to get a policy, the 3 seconds to get payment, all of that. That's the tip of the iceberg. That is the 10% of the iceberg that's above the waterline and that everybody can see. The real heft, and I think this is exactly what you were saying, Emmet, is the 90% of the iceberg that nobody sees, the parts that's submerged. And ultimately, that is what gives the iceberg its weight, and ultimately that's what sinks the Titanic. It's not the little bit that's sticking up above the waterline. And as we perhaps unpack in the coming minutes, AI and data and what is really the plumbing of insurance, I'm actually as excited as I am about Matt's experience. I'm even more excited about the data that it generated and how our systems learn from that and use it and will serve him better as a result of that. So I think actually we win in the end of the day, not with a cool app and good PR, but because the plumbing, the data that powers and the technology that powers insurance is actually where our transformation is deeper. In terms of other insurtechs, I'll say a couple of things. One is, sincerely, we wish them well. Ours is not a winner-takes-all industry. At 11% of GDP, there's room enough for everyone. And whether Lemonade succeeds or not is not dependent on others failing. So we don't look over our shoulder at how others are doing. We're not trying to outrun them. We're marching to the beat of our own drum, focusing on our customers, doing what we think needs to be done, and far, far more focused on the incumbents than we ever have been on other insurtech. So sincerely wish them well. Our success is not dependent on their failure. The striking thing to me about the other kind of insurtechs really has been that they've all decided to take a strategy of being monoline. So you've got Oscar doing just health insurance, and you've got Root doing just car insurance, and Hippo doing just home insurance, etc. And I just don't know how the economics of that kind of approach work. It's incredibly difficult business if you can't grow with your customers, if you can't sell them multiple policies, bundling, etc. In fact, what you're really doing, so long as you don't have a multiplicity of products, you are forcing your customers to go and get products elsewhere. And you know that the competition is going to be offering them a bundle discount. Hey, move your policy over to us. And so it increases churn, it sacrifices a lot of upside. So I think that rather than technology would be the biggest challenge as an outsider that I would ascribe to them. But as I say, I don't say that in any way to diss or anything like that. I have nothing but respect, and I'm friendly with most of the CEOs of the other insurtechs and sincerely wish them well.
Yeah, that's a really interesting comment about the other competitors being monoline. And to me, that kind of gets to the heart of what I think is the core investment thesis, or maybe not the core, but along with the AI that you guys are building, I think one of the most exciting parts of your business from an investor standpoint is, like you said, the ability to grow with your customers. So you guys have a customer base that certainly skews to the young side, and the in-force premium per customer is just very low at just a few $100s per customer. But when I think back to my own experience kind of starting out, when I got my first job living in New York City, had very little income, had very little assets that needed, insuring, versus where I am, a little bit later on in my life with a house, with 2 cars, with 6 kids. And, I'm almost certainly spending 10 times more, if not more than that, than I, spent when I was in my early 20s. So I guess that seems to me to be one of the things that's most underrated about Lemonade as an investment is this: not only are you growing your customers at a pretty rapid rate, which I think is impressive, but you're also joining them at this early stage of their life in a product which I think is unique among many other types of products, in which it's expected that customers will increase 10x or so the amount of dollar spend over time that they're devoting to this. So is that a kind of underrated asset, and do you find that others are kind of confused about that bit of the opportunity with Lemonade?
Yeah, it's really a textbook low-end disruption. So we come after the 20-something-year-old, and they'll pay us as little as $10 a month, sometimes $5 a month, and they'll be insuring $10,000. Here's an interesting stat. I hope I'm remembering it correctly. The net worth of an American on average under the age of 35 is $10,000. They may have slightly more assets, but have got liabilities, and nets out at about $10,000. And over the next 10 to 15 years, their net worth multiplies 10 to 15x. And it's exactly as you described. Your net worth grows, your responsibilities grow even further. You have kids and dependents, and insurance tracks to that, right? It really does. It tracks to that, and therefore you just have to step onto the conveyor belt of life and do what is expected of you and what you on average will do and will predictably do, and your insurance needs will grow 10x, 15x, sometimes 100x over the course of a lifetime. It's not unusual. People today will start with $60 a year. They may well be spending $6,000 a year on insurance in 15 years from now. So this approach to LTV is just so different to what we think about in the tech industry. Typically we think about LTV as being measured in 3 years, 4 years, 5 years. And you think if you're Spotify or Netflix or one of these kind of companies, you're trying to eke out a 10% upsell, a 20% upsell, buy 2 more screens or whatever it is, skip ads. And suddenly in insurance, lifetime value it's a measure of lifetime. If you bought it in your 20s, you'll be paying for it in your 80s. And you'll probably be paying 10, 20, 30, 40 times as much over those years. So that does kind of force us to think very much about building a long-term business. That's kind of one thing that I would point out. And that perhaps our existing book of business is hard to assess based purely on lagging indicators rather than projecting forward. And if you look at our premium per customer, it has been growing at a wild clip over the course of the last few years, and I imagine will continue. But I think it's a little bit more insidious than that. I called it a low-end disruption. When you go after a 20-something who's paying $5 a month, the incumbents don't care. They don't feel the pain. That's a customer they don't want. Those are premiums that are of no interest. Maybe if you turn to them, they'd sell something, but they really turn their nose up at those low-end premiums, and it's more of a nuisance sell than anything else. And their claims are nuisance claims. They're actually called nuisance claims because
is that right?
Yeah, they're known as nuisance claims. If your house burns down, fine, I'll get out of bed for that. But you lost your laptop, it costs me more to process it will literally cost them more to process the claim than it will to actually pay the claim. And this is actually where our advantage is at its most pronounced, because those younger consumers, we and the others may have a similar assessment of your expected loss. In other words, of what claims you're going to make. Let's say the actuarial stuff is identical for both of our companies. So we both have to collect enough to pay for your expected losses. But then we also have to collect our expense load on top of that, what it costs us to service your business. And that's where, since the denominator is so small, that's where we really shine, because Maya sold you that policy with 0 incremental cost. Your human that you bought your previous policy for charged an absolute fortune for processing your policy. So we do 98% of our policies are sold without any human intervention. So our cost to serve collapses to, the asymptotes to close to 0. And then when you make a claim, 45% of our claims are handled without any human intervention at all. And at the lower end, that percentage is much higher. It's the more complicated claims that we don't. So we have much less of an overhead on those entry-level policies. And you end up with this kind of trifecta, this cocktail that appeals powerfully to young consumers of incredible value, because we will often be half the price for an entry-level policy than the incumbents. And not because we're selling at a loss. It's illegal to sell insurance at a loss in America, but simply because our costs to serve are such a fraction of what the incumbents are. So incredible value. Young consumers, all consumers, but young consumers particularly, are interested in values as well. And being a public benefit corporation, a B Corp, and the give back resonates with them even more powerfully than it does with others. And then the tech. This is a generation who's not interested in speaking to dad's broker. They want to just do stuff on their cell phone. And if you can do it in 90 seconds while awaiting your coffee, then why would you do it any other way? See, you take that threesome together, and it means that we have a structural advantage in attracting young first-time consumers. And in fact, by all measures, we are probably the #1 brand in America for young consumers buying their first policy today, which 6 years in is a pretty crazy thing to say, just in terms of market share. And then it's exactly what you were laying out, Matt. Once you have that customer, if you can delight them, and we work very hard to delight them and to get NPS levels that are unknown in the insurance space, they're much more familiar to Tesla customers than they are to insurance customers, then you have earned the right to grow with them. And that's why we've been working so hard to bring out new policies. When we IPO'd just over 2 years ago, we only did home insurance, home and renters. And since then, we've launched life, and we've launched pet, and now we've launched car. So we've really worked very hard so that we can service those needs as you grow through those predictable life cycle events. And I'll just say, sorry, a long answer, but this is a core plank of our strategy. So I just thought I'd flesh it out a little bit. One way to conceptualize that, we don't often talk about this out loud, but I think it's a powerful metaphor, is to think about our renters business as negative CAC acquisition. Mm-hmm. It's profitable business. But if you think about it, not simply as a business, the renter's business as a business, but as potential homeowners, potential car policy buyers, potential pet, potential life, then you realize that we've just acquired all of these customers, well over 1 million renters that we've acquired, who are paying us more than it costs us to acquire them, which is why I'm calling it negative CAC. And now we have captive audience who will go through these predictable life cycle events. And already today, about a third of our car policies, about a third of our home policies, about a third of our pet, and about a third of our life policies are sold to that cohort. So it's already, even though we're only a couple of years in, we're seeing some powerful dynamics unpack in that regard.
You know, and that's such an interesting point, because I think one of the criticisms I most often hear about Lemonade is that you're you know, CAC to LTV. So for those who are not following the spaces closely, customer acquisition cost, you know, relative to the customer's lifetime value, calculated using historic metrics, as you pointed out. That gives you ratios that look unsustainable, that says, okay, you guys are spending too much on marketing, and you're cash flow burning essentially. But what you're saying is, don't look at it, you know, backward looking on all these, you know, renters customers that we're acquiring. Look forward into how many of those will have 5-10 years from now, and the lifetime value that they're going to get when they're, you know, not buying renters anymore, but they've got home and life and auto. And when you bundle all those together, that's, you know, where spending as much as you are right now on customer acquisition is actually, you're saying it's a negative acquisition cost essentially, right?
Yeah, I think a lot of those comments are actually flawed on their face, but they become even more problematic with a forward-looking perspective. So I say flawed on their face because our renters customers, for example, this is profitable business by any measure, even before you introduce upselling and growing with customers. This is a misunderstanding that perhaps we can spend a bit of time on, but we don't sell policies at a loss. What we do is we use leading indicators rather than lagging indicators. So we use machine learning models that have a pretty powerful predictive ability to say whether a person is going to churn, claim, or upsell. And we now have enough data that we can score every single customer who comes through our door, every marketing campaign that we run, every product and every geography in real time, all the time. And we are never looking at what would, you know, based on last 2 years' performance, what have we done today? We're looking at what, based on next 2 years' performance and the lifetime of this customer, should we be spending this buck against this acquisition or not? And without making any wild assumptions, just using historical data that machine learning can extrapolate from, we have been operating for some time now at an LTV to CAC of about 3. Which means we invest $1 now, we expect it to return about $3 over time. Now, from a cash flow point of view, and indeed from an accounting point of view, you're not going to see that return in the same year that you make the investment. So in the same accounting period, it will express itself as a loss, but investments do. And we're comfortable making them because we have line of sight of how the dollar invested today is going to return $3 later on. So we feel very comfortable with the investments that we're making with the LTV to CAC ratios that we're seeing.
So yeah, maybe this is a good kind of pivot point to start talking about, you know, the AI aspect of the business a little bit. I mean, this is one thing you were speaking about on the last earnings call, that, you know, just how quickly you guys are kind of shipping, you know, updates to the, you know, to the various models that you guys are using. So maybe it's a two-pronged question. One would be, you know, what are the kind of, you know, metrics that you're looking at from a business management standpoint to make sure that your, you know, customers are kind of progressing along on that, you know, bundling and upselling and, you know, the whole, you know, 3-to-1 LTV to CAC ratio that you spoke about? How are you ensuring that you're doing that instead of just back testing, you know, the historical data and, you know, it checks out there? How are you actually seeing the results increase in real time? And that's probably enough of a question to start off. So maybe we'll start there, and then I'll follow on with a subsequent question.
Yeah, so the metrics that we look at are actually all leading indicators. The dashboards that I open every morning are all forward-looking. Insurance is too slow a pace. Traditional insurance runs at too slow a pace that if you wait for, think about it this way, you bought a policy, whenever you bought a policy, knowing how you're what your loss ratio is going to be over time, for example, is a multi-year experiment. Losses do not come in a linear rate. They come in the first year in a way that is different to the second year, and second year is different to a third year. And it takes real time until you learn from the actual development. And if I waited 2 or 3 years and then started making corrections based on how you actually turned out, I would always be chasing my own tail. I'd be moving at a pace that is non-competitive. I wouldn't be able to update and decide where to spend my dollars tomorrow based on what I did today. I'd have to be spending dollars tomorrow based on what I did 2 years ago. That's a terrible way to run a business, and it's the way the business is typically run. We have the luxury of not having to do that. So the metrics that we look at all the time are predictive in nature. We couldn't always do this. We were at a data disadvantage until, I want to say 18 months ago, 24 months ago. This is still relatively new, but we now do have the models that we trust to the extent that most of our marketing expenditure, in fact, the overwhelming majority of our daily marketing expenditure is directed by machine learned models, extrapolating LTV to CAC, which itself is made up of a composite of models predicting churn, predicting claims, predicting upsells, etc. So we do run the business. These are the metrics that we follow. LTV to CAC is one that we optimize for with an extraordinary level of precision. And we couldn't do it if it wasn't for the machine learning models.
It really is astonishing. And I think one of the things that has leapt out several times during this conversation is just the potential for operating leverage. We spoke a lot about the revenue, how that has, the potential to really kind of explode just as your customers age. I mean, if you did nothing to increase customer count or marketing right now, and you just let them age, you could imagine that the in-force premium per customer several years from now would be a lot higher, presumably a lot more if you had all of your products available in all states. So that potential, I think, on its own is really exciting. But then on top of that, you're talking about how minimal amount of time humans are actually spending on claims, and kind of how efficient the kind of back end processing is. So it strikes me that when you guys get to a certain point in scale, assuming your loss ratios are industry average or better, and I think there's reason to believe that they could be best in class given your AI approach. But you could be at this point where you've got, best in class loss ratios and like by far leading, operating efficiency, which just creates this tremendous operating leverage potentially. Is that kind of the path that you're focused on? And I guess one of my questions is like, is this a vision that's well understood by a lot of the Lemonade investors and employees? Because to me, it's super exciting. I think insurance can be a space that sounds boring, but when I think about those dynamics, I think that's exciting as an investor, but also just from an economic efficiency. Like we should be striving to make things better, more pleasing to the customer, and providing better value overall. So I guess just it seems like we're in a little bit of an echo chamber with how excited we get about this. And I'm curious, if you find most people seem to get this within your circles.
I share the excitement. I share the excitement. I don't know. I think it is difficult because if you're not seeing the leading indicators, if you're just looking at the lagging indicators during the early stages of insurance, when it's all about investment, about building the technology, about building that 90% of the iceberg that you don't yet see, about acquiring customers who are going to be worth a lot, but at the first year are actually a loss-making customer. And so much of our business is front-loaded. I'll unpack that for you in a second. Then it can be a little bit hard to believe. You say, well, it all sounds good, but I'm looking at their financials and I'm just not seeing it. And I understand that. I really do understand that. It takes the kind of deep conversation that we're having now to try and unpack those dynamics and split the past or the present from the future and understand why we have confidence in what we're doing. So I'll say 2 or 3 things. One is, yes, I think absolutely every line is done better through software. So you bought a homeowner's policy, 98% of our homeowners policies are sold through Maya the bot or APIs with no human intervention, period. About 95% of policies in America for homeowners are sold through agents. It's like a mirror opposite.
Wow.
Yeah. So, and they take 15 to 20% of premiums in perpetuity, not just the first year that you paid, every year thereafter. Now, let's just take that as a talking point to highlight some of the differences between our model and theirs, because the differences run deep. And at first, our model looks worse. Why does our model look worse? Because we spent on CAC. We acquired you as a customer. So I don't know about you specifically, Matt, but we'll have paid Google so that when you did a search, our name will have appeared there. You'll have clicked on us, or however it is that we target you. So we've incurred all of the CAC upfront. We take a wham on the first year. And by the way, that same first year, your claims will be the highest, your churn will be the highest, you'll be your least attractive as a customer, and our cost structure will be at its highest. It's different for incumbents, because working through an agent means I don't pay a penny. I have no upfront expense. I share my proceeds with them in perpetuity. So now I have a partner siphoning off margin forever and a day, but my year one doesn't look different to my year two or my year three or my year 10. I've just got this drag on my earnings forever, but it's not front loaded. So I didn't take a cash hit. I didn't take an EBITDA hit in acquiring that customer. Now, if you're long-term in orientation, it's nice to take the hit once up front and then own the customer throughout their lifetime. But in the near term, particularly if you're growing fast, then a lot of your customers are first or second year customers. They haven't yet reached the I in the ROI, the R in the ROI, that you're doing loads of investment, but not yet return. If you stop growing, you see it very quickly. But if you want to keep growing, you're constantly adding more and more first-year customers, front-loading the expenses, spending on the CAC, taking the hit to the loss ratio. Year three, they're already looking like incredibly profitable customers, but by then you've stacked on a lot more customers. So once you understand those dynamics, and if you're a long-term business builder or investor, then you say, oh, I'll definitely invest $1 now to get back 3 later, and I don't mind that it will appear upside down on the economics. And by the way, pile on loads of those, because even if it creates a negative EBITDA today, I understand how that plays out over time, and you're just compounding my returns, so bring it. But it looks very different to a traditional insurance company, agent-based, with the cash flow looking better and just the margins looking abominable further down the pipe, the path. Let me add one more thing and try to mix in. So at the expense, yeah, sure, I spoke about Maya. This is true in claims. 98% of the time, our first notice of loss is taken by the bot. 98% of the time. And almost half of our claims are handled without any human intervention at all. It's in the mid-40s.
That's great.
That's without parallel in the industry. This is without parallel in the industry. Now, of course, it delights consumers, because if you get your claim paid instantaneously, you don't miss the human contact. You're like, great, I got my money. I'm golden. And you collapse costs beautifully. And technology can do that, right? It can collapse costs while adding to the delight. So that's claims. The whole operation behind it, yeah, we pushed something like 12,000 software builds in the last year alone. And most of the software builds were themselves pushed by a bot. We have an internal bot called Cooper who does our DevOps, creates the development environments, pushes to production, manages loads of those things. So at every stage, you see tremendous efficiency that you need scale to really benefit from. Because at the beginning, you're piling on investments in the tech. And then as you grow from 400 to 600 to 6 billion to 60 billion, you don't see those expenses grow in time because you've built for scale. The final point I wanted to make. Most businesses that you care to think of benefit from automation. And if it's done thoughtfully, then you get both an NPS hit and you get an EBITDA hit in the best sense of the word. Insurance has something that most other industries do not, which is, you think about how AI is used by Amazon. You go into Amazon and everything's automated, and you may like this and you may like that and all different cool stuff. And you go to Spotify and Spotify will recommend songs and help you with discovery. And it's all using machine learning and AI in a powerful way. You go to Uber Eats and they'll explain to you how machine learning is planning the route and capacity planning and all these kinds of things. But what Uber Eats delivers is sushi. And that salmon that you eat is unchanged by machine learning. So everything around the salmon is changed by machine learning, but the actual core product is, a piece of tuna fish or whatever it is. Mm-hmm. You go into Amazon and you buy a new toaster. Everything except for the toaster was impacted by machine learning, but the atoms of the toaster are the same atoms that you'd get if you went to the high street and bought the toaster there. You go into Spotify and you play Sgt. Pepper that was recorded in 1967. The bits that you're hearing are the same bits that were recorded back then. Everything around the product has changed. And industry by industry by industry, if you think about them, they're usually selling you either electrons or atoms. And both of those are impervious to machine learning. What machine learning is incredible at is algorithms. Insurance is the monetization of probability theory. The salmon of our industry is statistics. Mm-hmm. That is the core product. Everything around it is agents and advertising and other stuff. And we've just spoken about how all of that can be automated away. But when you peel all of that out, what you're left with is the ability to predict the future using data from the past. That is the building blocks. That is the factor of production that is at the core of insurance. And why I find this so exhilarating and I get so animated about this is this used to be where insurance absolutely dominated. The modern insurance company born in the 1600s in the height of the scientific revolution, as probability theory was being formulated and Bernoulli discovered the law of large numbers and all this cool stuff happened and Lloyd's of London and Aviva in the UK and all of these insurance companies started out. And then for 300 years, insurance and statistics co-evolved. They fed off each other. And if you stopped a person in the street in the 1700s, in 1722, and you said to them, hey, who is bastion of the world's data and who is home to its finest statisticians that have named an insurance company? And in 1822, that have named an insurance company. And in 1922, that have named an insurance company. And I think in 1992, that have named an insurance company. And today, 2022, it won't make the consideration list. Nobody will even think of the insurance company as being the bastion of the world's data and home to its finest statisticians. It's all Silicon Valley. Insurance has lost supremacy, has lost dominion over the most important factor of production of our industry, which is data and statistics. And that's why building an insurance company from scratch, that's that 90% of the iceberg, Emmet, that we were talking about before that's submerged. That is why this is so exhilarating, because if you build insurance as a Silicon Valley company with data substrate as its foundation, then not only do you help with all of those other layers of cost, you actually revolutionize the salmon. You revolutionize the actual product itself.
The essence of it. Yes. No, it's a great point. Yeah. Very exhilarating to think about. I agree. Yeah, 100%. Just to pivot a little bit. I mean, I think car insurance, I want to talk about a little bit is the most exciting development for Lemonade as an investor, for Matt and I think many investors. That's the most meat on the bone we can see in terms of revenue and profits in the foreseeable future for Lemonade to accrue. And just quick, how is the car insurance going, the rollout? I know it's you guys acquired MetroMile, and that, congratulations. That there's no easy task to go through that whole merger process, and a lot of employees to assimilate and cultures mixing and all that. So it's probably a lot to integrate. But how's the car insurance stuff going? I'm just curious.
So far, so good. We haven't had a full quarter yet since that acquisition, but things have gone very much to plan. Just fabulous people at MetroMile, and the cultural fit is something we spent a lot of time on prior to signing the deal. We're not very acquisitive because of that vertical integration that you spoke about earlier. Mm-hmm. We want to end up with we've always been, and we want to continue to be, one brand, one technology stack, one central customer that we can service in all different ways. We never want to get the legacy problems of system archaeology. So a lot of time was spent on how we can emerge from this process, a single team, a single brand, a single system. And I think we're well on our way to doing that. I share your excitement about car insurance. It's in addition to being one of the largest spaces out there, it is also one of the most competitive, and it has some of the most impressive competitors. Geico, Progressive, they do a lot of direct-to-consumer advertising. It's different to homeowners. I couldn't quote that same stat that I quoted before about homeowners, which is why we started that, because homeowners is so retrograde and car isn't. So the challenges are different. If you want, we can unpack a bit how we're trying to approach that and why we think we have a right to play in this space, but it's not a trivial thing to go up against brands like Geico and Progressive.
Yeah, absolutely. And my understanding is the telematics on, on the app of people's Android or iPhone plays a large role. And, the competitors don't quite take advantage of that technology the way they could for some trivial or legacy reasons or something. I mean, I've heard you explain it before, but maybe you can just touch on that if you don't mind.
No, not at all. I think this is actually core to understanding our playbook, and we don't mind spelling it out because I'm not sure that incumbents can do all that much about it, even if they understand our playbook. And time will tell whether we're successful or not, but at least we can articulate what we're trying to do. Car insurance is, I really don't want to understate how awesome or fearsome or whatever our competitors are. We have a lot of respect for them, and we enter this space with some trepidation. And we're not going to look to grow it too fast. We're going to take our time, let the data accumulate. These are high premium products. We have to make sure that the systems are learning before we go full gas in the car space. But the theory is, I think, pretty compelling. It goes like this. Telematics is a game changer. Telematics actually changes everything. And incumbents are loath to use telematics. They say they're not, but there's structural reasons why they really, really are. And telematics has been around for a while. But the theory goes like this, and then I'll give you some statistics just to demonstrate the point. If you have a huge book, your Geico, Progressive, whatever, you've got $40 billion a year coming in on your car insurance policy. A wholesale adoption of telematics would get the CEO fired. Because what it would reveal, and we know this for sure, is that 2/3 of your customers are overpaying. 2/3 of customers drive less than average. And how much you drive is the #1 predictor of how many accidents you're going to have. And if you don't know how much people drive, close your eyes to that factoid, then you're going to price people without knowing that, and you're going to be indifferent to that, and you're going to bundle millions of people as if they're monolithic, as if they are alike, where they're not. And that's okay because everybody's doing it. So it's not a competitive disadvantage to do that. So you just take huge swaths of humanity, pretend that they are monolithic, and price them accordingly. Then along comes this technology that allows you to actually differentiate it at a radically greater level of precision, and to break up these huge monolithic pools into really pricing at an individualized level. And that sounds like it's goodness, but if it means now I've got this business I have to protect, this 40 billion book that I've been chartered with husbanding, and if I now have to lower rates for 2/3 of my customers, what does that do to my earnings? How many CEOs do you know who would have the gumption to take that step wholeheartedly, unreservedly? And the other thing I'm going to learn is that 1/3 of my customers are underpaying. They're being subsidized by the 2/3 that I'm overcharging. So I've got to lower my rates for 2/3 and give up all of that revenue. I've got to hike my rates for 1/3 and lose 1/3 of my business because they'll churn. And that's just an impossible proposition. It's the classic innovator's dilemma. You just don't want to go there. In the last AGM, Berkshire Hathaway spoke about this. They own Geico. Warren Buffett owns Geico. They own a lot of insurance companies. And their words at the AGM were that Geico has absolutely missed the bus when it comes to telematics. Direct quote. And you ask yourself why a company as smart and as far forward-looking as Geico would totally miss the bus on telematics that's been around for 20 years. And I think the reason is what I just said, which is you don't have it'd be terrible for you to go all in on this technology. So now, at least 1 decade, maybe even 2 decades after the technology has been available, certainly the last decade, it's been at a reasonably high level of trustworthiness. 4% of policies in America use telematics. 96% don't. And that 4% number is a woefully overstated number as well. I'll tell you now that over 90% of our customers use telematics. And when I say 90% use telematics, they have it on constantly. It's not a 2-week trial. It is a continuous monitoring of driving. And that's important because when I say it's over 90%, the people who don't, they used it for a while, but they don't have it on right now. We don't call that using telematics. The 4% that the industry uses to say, oh, we've got 4%, that's 4% whoever used telematics. And usually they'll run it for 2 weeks and then turn it off. They'll do it to generate a quote and then they'll stop monitoring. So number one, 4% versus 90%. Number two, continuous usage versus episodic once-off usage. And then number three is that even that paltry data that they get in those 2 weeks for those 4% of policies, they underrate them. In other words, the true actuarial impact isn't passed on to the consumer because that would cannibalize their existing business. So even what the true actuarial indication would be for most incumbents who are using telematics, they don't pass it on because they've got this legacy business to protect. And you really see textbook story of innovators' dilemma. And I do not envy those CEOs. I don't think any of us in their position would do things any different. That's what makes this a structural issue, right? It's not dependent on the personalities involved. And I'll add just one more thing. And again, this is a long-term play. Anybody expecting us to transform this industry in the near term is not aligned with our thinking, at least, about this. When you play this forward, once you're able to match rate and risk at a level of precision that our technology allows and that incumbents lack and are loath to fully adopt, once you have that, then what you find is that for good customers, good defined not as a moral virtue, but in terms of their risk profile, we will charge them a lower rate than that average, the peanut butter approach of the incumbents. So if I take you guys and I say, well, let's for argument's sake say that Emmet drives less and drives more cautiously than the average, then he will find that when he gets a quote at Lemonade, he can actually save considerably by switching to Lemonade. So he will switch. And the incumbent that he switched from will have one fewer customer subsidizing their bad risks. And they will have, because they're getting adversely, we're going to get positive selection, which is good risks will come to us. What happens when a bad risk comes to us? They get unattractive pricing. They're better off with the average pricing because they're worse than average policy.
That's the bad driver in this example.
Yeah, no names.
Make me that bad character.
No names. I stopped myself just in time.
I know, but it was implied though.
Let's say he was
so
called
it's a death spiral though, right, Daniel? I mean,
that's exactly right.
Saying you get the good customers and the bad customers will stay there and they'll push the average up, which will make more of an incentive for good customers to come and use telematics, which, you know, then it's just it's a flywheel, it's a death spiral.
That's exactly right. And you understand why it doesn't happen overnight, but you understand why if you take a strategic approach and a long-term approach, again, you see the structural advantage that we believe will manifest over time.
So one question I have on there, you know, from someone who's not in the data all day, my suspicion would be that, you know, MetroMile's approach, which is, you know, constantly using, you know, the live data that they had, would have resulted in, you know, very attractive loss ratios. But, you know, at least as of the latest data that we've seen, you know, their loss ratios certainly need some work. So what is the kind of issue that you guys are trying to work through right now in order to, you know, kind of slowly, cautiously, you know, get those ratios where you need them to be? What are the biggest challenges in that space?
Absolutely. I'd like to open parentheses and make one comment about loss ratio that's kind of general, and then I'll come back to your point. We don't aim to have the lowest loss ratios in the industry. We aim to have the lowest loss cost in the industry. What I mean by that is a loss ratio is a ratio. And if my losses are X and I lower my price, then my loss ratio goes up even though my losses don't go up. And as we get better and better at underwriting and pricing insurance, we can choose how much of that to retain as profit and how much of that to pass on to the consumers as lower price, and then feed our growth in that fashion. So actually, where our loss ratios end up, we're not aiming to continuously drive that down. We're aiming to pass on a lot of those savings to our customer and have a healthy loss ratio and a profitable book of business. But if we can continue to undercut incumbents in terms of price, then that fuels our growth, and therefore don't expect us to always be celebrating the lowest loss ratio. We want healthy loss ratios.
So if I can interrupt, if I understand you correctly, you're saying that from like a Lemonade net present value perspective, it may be a better choice to accelerate your top line growth by offering lower rates at a slightly higher loss ratio, as opposed to driving it down to the lowest industry average. So there's a trade-off there, and it may not be as apparent to just an outside observer who sees your loss ratio, what the trade-offs that you're pursuing might be.
That's right. And one kind of mental exercise that you could do is say, well, our loss ratios are, X, but we're 20% cheaper than the incumbents. What happened if we added those 20% back in? What would our loss ratios look like? And then you're comparing apples to apples.
Yeah, that makes sense.
That said, in certain parts of our business, our loss ratio is higher than we want it to be. So kind of close parentheses, because that's a generalized point. But and honestly, this is some of the tackling of the insurance industry and where technology hits the time lag of insurance. So MetroMile knows exactly what they need to do. The data is incredibly clear, incredibly precise. It has been packaged as a rate change and filed with the California and other regulators who have been sitting on it for close to a year. So we know, and they already knew before us, exactly what needs to happen. But at the end of the day, the long pole in the tent is oftentimes regulatory approval cycles. And with all the best data, you end up at the best place eventually. But oftentimes there's just months of delay that the process, the bureaucracy, the regulatory system puts in place. And that more than anything else accounts for the loss ratios they're asking about.
That makes a lot of sense. It may be kind of along the lines of the trade-offs that we were talking about earlier. We're obviously in a very strange kind of macro environment now with inflation the way that it is, and that certainly impacts your regulatory filings everywhere that you operate. I'm kind of curious what other impacts you're seeing, as customers are dealing with the changing economy, and you're making different trade-offs based on your cost of capital, as you talked about in the last earnings call. Just curious if you can give kind of an update on what are the things that you're seeing right now and how you're managing the decisions in this very unprecedented environment that we're in right now.
Yeah, from a customer point of view, we're not seeing much. So cost of capital and inflation are, as we did write in our latest earnings, they are front and center, and we can unpack those if you like, but those do impact our business. Inflation most directly. You're collecting premiums today to pay for something in the future, and if that thing goes up in price in the interim, then you didn't price it appropriately, which is why the slowness of the regulatory approval cycle hurts in a high inflation environment. And you see GEICO, for the first time in decades, this last quarter had an underwriting loss. That's the reason. This is impacting the entire industry, and we're not immune to that, and we don't have a technological workaround for the regulatory process. So we do get hit by that. But demand has remained strong. Unit economics has remained strong. Churn, all other things are healthy and good. So actually, if we weren't seeing and reading what's happening at the macro level, we're not seeing it in our business. It's one of the amazing things. I'd love to take credit for it, but it's really just one of the wonderful things about the insurance space and the kinds of products that we're selling. They are highly resilient. They're almost counter cyclical in terms of macroeconomic downturns. People need to buy insurance. Home insurance, oftentimes renters insurance, always car insurance is a non-discretionary purchase. You can't get a mortgage without it. You can't drive a car without it. So you don't see that change much. And if you look at the kind of charts that we publish, like our top line growth of customer or premiums or anything else, it is one of those beautiful up and to the right, uninterrupted lines with no reversals. And I say that because you look at it over the course of the last couple of years and you think about all the things that have hit the economy and the country and COVID and everything else that's happened. And what's happened to the stock market, if you were to map our stock price over that would be just wild gyrations. And yet the business has been steady as can be, 10 quarters of hitting, beating, and raising, and just everything has been predictable and bankable in a way that's unusual for a company at our size and stage. So I have to say, it's just been a pleasure during these tumultuous times to be in an industry that is relatively insulated, and we're not really seeing a lot. There's talk of raised fraud, for example, which will not be a surprise as things get worse. But honestly, it's not at a level that we're even detecting it right now.
Yeah, one last thing, wanted to just ask you your opinion as an investor. If you were an investor in Lemonade, we try to look at leading indicators. I mean, we've seen some creeping up of the Lemonade app in the App Store and Google searches and stuff. To us, that's a striking leading indicator. Are there any kind of leading indicators, that you would suggest investors consider looking at for the success of Lemonade's business?
I do sometimes see tweets or commentary about the App Store, Google search and stuff like that. And I respect and appreciate retail investors or others seeking out those kinds of signals. For myself, I don't monitor those, to be honest. And just because I've got more dependable internal data and, as a predictive modeling that we use. So I'm much more reliant on that than those, and those aren't public, those are proprietary. So nothing that jumps to mind. The key things that we publish: annual dollar retention, premium per customer, in-force premium, all of these kinds of things are obviously powerful indicators and are closely monitored. But in terms of alternative data sets, I think the ones that you highlighted make sense, but I haven't really spent enough time on it to have anything intelligent to add on that.
Okay. And we really appreciate you coming on here. There's another parallel. We talked about the similarities with the fintech thing early in the discussion, but we cover very closely Tesla, and I've followed Tesla for many years. And 10 years ago or so, when I was following Tesla, there was a number of employees who they didn't understand the big potential that Tesla could become that it is today. And they didn't take advantage of their own company's stock incentive plan and all that. This is my understanding now. I didn't know that 10 years ago, but after talking to lots of employees in the last couple of years, I've come to realize this was the case for Tesla 10 years ago. And so everyone's kind of in their own silos. Do you think enough Lemonade employees currently understand the opportunity and the potential for Lemonade over the next 10 years? I mean, it's enormous. I mean, the total addressable market, as you said, is ginormous, and you just need a small slice of that and to succeed. And it's like a huge, we think of it as like a binary outcome. Like if Lemonade succeeds, it jumps up wildly, and it's total market cap, it's revenue, everything, the whole business. If it doesn't succeed, someone buys you for pennies on the dollar of what it is now for the technology you guys have built, which is incredible. That's the worst case. So we try to put odds on that. So we think of it as like a binary. But to us, the odd, the odds are in favor of succeeding over long enough time horizon. But the part of that is execution by the employees, right? So the employees have to be motivated. They have to know like the big picture. Do you think enough Lemonade employees understand the big picture?
I do. I do. We monitor as closely as we monitor NPS. We monitor the same for our team. Mm-hmm. We closely monitor churn, not only of customers, but of employees. We enjoy a very highly motivated team of just some of the most outstanding people I've ever had the privilege of working with. Just incredible. I get to come on and chat to you guys and kind of be the face of and take credit for work that I do very little of it. Obviously, it's 1,500 or so are just extraordinarily highly motivated, highly trained, highly focused people working in a pretty interesting structure of kind of squads where they're all in really tiny startups within Lemonade, with just an amalgam of tiny startups. So everybody comes to works with a small group of 7 or 8 other people, and they have their own mini startup, and they can operate at incredible speed and with tremendous autonomy, and that throws off the kind of stuff that we've been talking about. But yeah, my one word answer to your question is yes.
Good. That's great. So we're wrapping up. I think we're coming to the end of the time. We're similar. We've taken a page out of your playbook at Lemonade, trying to be more charitable with our business model. And so we give away $10,000 to a charity of choice of the people we interview. And so I think we told you about it ahead of time to think about a charity. What charity did you decide? And we can spend a couple minutes just briefly. You can tell us a little bit about it, and we'll make the donation after we close the call.
Well, Emmet, Matt, I'm deeply moved by this practice of yours. It's just extraordinary. And really hats off, and it's not my place to thank you, but thank you. And I think it's extraordinary. I've done interviews and I've done podcasts, and I've never been in this kind of a position before. So kudos.
Thanks.
We work with some really amazing charities at Lemonade. We've got this give back program and work with dozens of incredible charities. One of the charities that we worked with continuously since day one is called New Story, and they were founded the same year that we were, in 2015. And New Story is all about building homes for people who are living in shanty towns or otherwise don't have access to a decent home. And they are a highly focused operation, highly motivated, very much a startup kind of approach. Brett, the founder, comes out of Y Combinator and brings a lot of the tech disciplines to the nonprofit world, which is, I think, such a great place to apply a lot of those skills. And you can build a home for a family for as little as $6,000, or rather they can.
Wow.
So your donation will build more than one home for a family. It's that efficient, their operation. And when you make the donation, you also get access, and you'll be able to see with tremendous specificity where all the dollars went. You know, now they're doing the plumbing, and now they're doing the roofing, and now they're doing this,
cool.
that, or the other. Mm-hmm. And they've been working with 3D printing of homes and all different stuff. So I love what they're doing. I love the kind of ROI that you can get on a $10,000 investment, and to know that you are housing an unhoused family. So with your permission, and assuming this meets with your approval, I'd love for the donation to be earmarked for New Story.
Yeah, absolutely. Daniel, one of the other things, I know we're bumping into time, but I'd love for you to talk about a little bit, if you can, is some of the stuff that Lemonade is doing also on like ensuring crops in the emerging market with blockchain technology, the kind of specificity that you're talking about with what's being done, like when the roof is going in, when the plumbing is going in. To me, it seems like that sort of stuff is enabled by the kind of real-time on the ground information that you get on a blockchain. So is it a similar kind of technology? And if not, maybe you could just give a quick plug for some of the really interesting, innovative, and good for humanity work that you guys are doing on the charitable side also.
Thank you. I'd love to. So we have two main platforms for giving. One is what we call our give back, which is really a portion of premiums that is left over at the end of the year that's donated to causes near and dear to our customers' heart. And we don't think about it as being generous, in the sense that we think this is solving a business problem. Insurance is plagued by dishonesty and distrust. It's perceived as a zero-sum game, where it's a conflicted relationship between insurer and insured. You make a claim for $10,000. If I deny your claim, I'm 10,000 richer, you're 10,000 poorer, and vice versa. So the perception is one of a conflicted two-party game, if you kind of want to think about it in game theory terms. And for us, our give back changes the nature of the game. We've never thought that insurance has a problem of people. It has at every point in this conversation as well, I've spoken about structural impediments and how we're trying to structure things differently. I think the distrust is the same. If I suddenly became CEO of a large incumbent company, I would be no better and no more charitable and no anything than the next gal or guy who'd take that position, because the game really determines much more than the players. So we tried to rethink the game when we founded Lemonade, and we turned what is a two-party player into a trilateral game with a nonprofit in the room. And now I tell you that leftover money goes to a nonprofit. When you bought your policy, Matt, Maya asked you after you bought your policy which charity you'd like to donate to, and I don't know what you chose. But when you come to make a claim, she'll remind you of that choice. And hopefully it won't be for many years to come, but when eventually you need us, one of the things that we will do is trigger a memory that, hey, you're not fighting this nameless, faceless behemoth with whom you have a conflicted relationship. You don't get to stick it to the man, because if you're going to stick it to anybody, you're going to be sticking it to a charity near and dear to your heart. And that flips a switch in your mind when you think, because most insurance fraud isn't carried out by gangs, from 10 time zones away. It's carried out by people like you and me, who feel that they are in this conflicted relationship and it's an unlevel playing field and they have to do what they have to do, kind of thing. So we're trying just to bring you back to the level of honesty that you have in the rest of your life, because insurance is an outlier. It lets people behave very poorly. We're trying to kind of bring it back down to earth. So for us, the give back is solving a business problem. And therefore, we've never apologized to our investors or asked their permission for give back. We think it is accretive to shareholder value. It is solving a business need, and therefore we're doing good, but we are genuinely adding to the customer interaction, to the relationship, to the retention, to the acquisition, and to the honesty of all players, and solving a business need. So that's one category, as give back. The second thing that we did is just before our IPO, by unanimous vote of all of our shareholders, we donated 500,000 shares to the Lemonade Foundation. So this is now not at the expense of not the designation of our customers, but now at the designation of our investors. So we created the Lemonade Foundation. It sold a bunch of shares. It now is sitting on some cash. And what we're trying to do there, so this is not strictly Lemonade. This is a nonprofit, our own nonprofit that the Lemonade shareholders established. And it really is, at least nonprofits are not owned by anybody. And therefore it's not owned by Lemonade, although there is some historical affiliation. And what we try to do at the Lemonade Foundation is leverage technology for the good of humanity. And the Lemonade Crypto Climate Coalition, which is the coalition that we put together that you're referring to, sold its first policy yesterday. Wow. So we've been working on the on a premise for the last few months. We announced this in March, and we brought together a bunch of players from the crypto space, from the insurance space, Hanover Re, different providers of smart contracts, blockchains, with the theory being that there's something like 2 billion people on the planet who are subsistence farmers. They live off what they grow, either in the sense that they eat it, or they sell it in the market and they use that to buy their food. Either way, they're awfully exposed to weather outcomes, particularly climate change. So these are the people, the humans who need insurance most, but it's least available to them because they're operating at under $1 a day oftentimes. So for them, a policy premium would be a few bucks. A payout would be $60. It's life-saving to them, but no insurance company can do that. You can't operate. It's just the cost to run a traditional insurance company means that it's just an impossibility to ever sell these people insurance in a way that would make commercial sense.
I mean, earlier in this conversation, you were talking about a $20 a month renter being a nuisance customer for an insurance company. I think I saw in the tweet that Shai put out yesterday, the premium was 83 cents. And of course, no company could handle that if you have an agent in the loop. It's got to be all back end supported.
That's right. So what we've done here is we've taken the insurance company out of it. This is a DAO. And we're establishing an insurance DAO and a smart contract. So the customer that you'd have seen in that tweet was using her phone, and it can be a feature phone, using M-Pesa to use her fiat money, which is then bridged onto Avalanche and executes a smart contract behind the scenes, which then has an oracle that will type into the smart contract what the weather patterns were as a matter of fact. So there's no claim. This is an auto-executing smart contract that, dependent on yields or other stuff that we can pump into via an oracle into the smart contract, will either make a determination that the event has happened or hasn't happened, and therefore will execute the smart contract and pay her or not. And suddenly you're in an environment, because this is built on Avalanche, which has incredibly low gas fees, you can start doing things for 83 cents and the whole thing just works, and there's no humans in the loop at any stage. And really and there's no profit motive. And suddenly you can start bringing insurance together with technology, specifically crypto, into the real world. And I just love how much this flies in the face of everything that we think about crypto so often, which is that it's something so otherworldly and disconnected from the real world, and it lives, in its own little bubble. And of course, there's nothing more earthly than a farmer trying to protect her maize crop from the vicissitudes of the weather, and being able to do that using technology, using crypto or blockchain specifically, I think is just very heartwarming.